in ABFM, basically we have to do two modules, okay, module A and module B. So module A includes theory part, that is completely theory, that is based on basics of management and then functions of management you have to study. And if you look for module B includes those part which is related to financial management. Okay, so and that module B will be including obviously theory as well as practical. Okay, so numericals also you are going to get in module B and theory also you are going to get. So approx I can say if suppose 25 marks question is coming from one module, approx I can say somewhere 10 to 12 questions or 13 questions approx you will get numericals or practical questions. So obviously this module B helps you in scoring plus 50 or nearby 50 or above 50 if you have to score. This module B is very, very important because already you'll be doing in ABFM this module B and module C. This covers numerical parts. Okay. So that is the reason it's very, very important that we should do module B properly. So what I will do, module A I will do later in last because that is completely theory. Module B I will start first so that you will get sufficient time to practice numericals, sufficient time to go through all the problems. Okay, so first I'll start with module B and then we'll move for module A. Okay, is it fine? Yeah. Okay. So let's understand first basics of financial management. Okay. So just 1 second. So if we talk about concepts of financial management, the first thing what we have to look here is sources of finance and financial strategies. Okay. We have to talk about various sources of finance. So suppose you are running a business or you want to start a business. So what all sources you will be having from where you can raise the funds, right? So either you can borrow funds from your friends, from your relatives, you can take loan, you can take some funds from any money lenders also, right? Correct? Or various ways are there from which you can raise the funds. So this is common ways normally which we follow. But suppose you want to raise funds through public. Okay, so we have different sources. So in that source, first one we have equity capital. Okay, so what we call as equity capital. So you are going to invest and you will be treated as the owner of the company. So company is going to issue the shares and investors are going to invest in the company. And for that, they'll be getting the ownership in the company, right? So that represents basically the ownership in the company. Okay. And what you are going to get if you are investing in equity capital, if you are buying the shares and you are investing, so you are going to get dividend. Okay. You are going to get dividend. Okay. What we call as dividend. So dividend, obviously it's a part which you are going to get when company makes profit. So when company is making profit, then only you are going to get the dividend. Right? Okay. So obviously when company is making profit, if company is making loss, then obviously company is not going to pay you dividend. So as you are owner of the company, so you are going to get dividend when company is making profit. Then obviously you will get voting rights. Okay. As you are the owner, so you will be getting the voting rights. Okay. So voting rights, you will be getting it if you are investing in equity capital. Okay. Then second, we have internal accruals or also called as retained earnings and all. Suppose you want to raise funds, you don't want to raise funds through external source. You think that no, I should depend on internal sources. So what all options you are having, right? So mainly you use retained earnings. Okay. Like suppose you are making profit, you are getting earning, right? So that earning either you use for paying the dividend, right? As I said that you are going to pay dividend when company makes profit, right? Correct. So either you are going to use that funds for paying the dividend or for growth and diversification of the business, right? So that is what options you are having. Retained earnings, you can retain the earning with you for investment for growth, or you can sell assets. Assets also you can sell if you want to do internal fundings or internal accruals you want to do. So these all options you are having. So reinvestment you can do. So in detail you can read it. Okay. Then we have preference capital. So this is also share capital, but you will be getting certain preferential rights because name itself suggests preference capital. Okay. So you'll be getting certain preference over equity capital holders. Okay. So one thing is that you are going to get fixed dividend. Okay. So you are going to get fixed dividend. So obviously all share capital holders are going to get dividend. So you are going to get fixed dividend. And what kind of preference you'll get? So first preference you'll get before equity shareholders, you'll get the dividend. That is one thing. Second thing, obviously, when we are winding up the company, when we are closing up the company, obviously we have to return back the amount of investors, right? Those investors who have invested my company, if I'm liquidating my company, if I'm closing my company, right? So what I should do? I should return back the investment, right? Isn't it? So first preference will be given to the preference capital holder. Okay. So this kind of preference, these shareholders are going to get. That is the reason name says about preference capital. They will not be having voting rights. We can have different types of preference capital. It can be cumulative preference capital. Cumulative means when dividend will be keep on adding. Suppose any old dividend we have not paid, so we can add it and next year we can pay. Non-cumulative means which cannot be added. So those those preference shares which dividend cannot be added. Redeemable, which can be redeemed after 5 years, 10 years of time. Okay. Convertible means which can be converted into equity shares. Okay. That is called as preference capital. Is it clear? Any doubt? Then next we have term loans or debentures. Okay. So these are quite similar things. So obviously about loan, you know, right? So about term loans, if we take loan from banks, so obviously we have to pay interest, EMIs, loan, all those things we have to pay, right? Okay. So term loan can also be one source. Then one more thing is there that is called as debentures. Okay. So debenture is a debt market instrument, long-term instrument, obviously for longer time. Okay. The long-term instrument. So obviously in case of it's like a loan only, but loan will be taken from public. Okay. So in case of term loan, you'll be taking loan from financial institutions. Okay. But in case of debenture, you will be taking from public. So what you promise that you will be giving the fixed interest. Obviously, you will take loan from the public. So why they'll invest? Why they'll give you loan? Why they'll give you money, right? Because you will agree that I'll be giving you fixed interest every year without fail. Okay. Every year, fixed interest. Every year I'm going to give you without fail. Here, if company makes profit, loss, doesn't matter. Okay. Company has to pay interest every year without fail. Same like if I take loan from your bank, I have to pay interest without fail, isn't it? Can I give excuses that I'm not making profit, I'm not getting salary? Can I give such excuses to you, to your bank? I have to pay, isn't it? So same way in debenture, in case of dividend, I can say that, okay, we are not making profit or we are not getting profit. Okay. But in case of debentures, okay, we have to pay fixed interest every year without pay. Is it clear? It can be secured, it can be unsecured, means secured through any asset. Convertible, non-convertible, if you are talking means which can be converted into equity shares. So some debentures can be converted into equity shares after some time. So it will beginning only, it will be clear that whether it is convertible kind of debenture or non-convertible kind of debentures. Okay. And as I said, you are going to get fixed interest. So remember that, keep in mind that debenture holders are going to get fixed interest every year without fail. That is called as coupon interest. Okay. Is it clear? So these are various meanings. So other kind of financing is also there. Lease financing, asset financing, factoring. So mainly this you have to remember, keep in mind. So some questions they can ask based on the meaning or the type of debentures or preference shares, some conceptual questions they can ask. So theory, you have to give little bit time and read in detail. Okay. Is it fine? Is it fine? Any question? No, see, when any resolution to pass or any decision to make, obviously you are the owner, right? Okay. So it's obviously you have to make use of your vote. So normally what happens if we are making use of our vote, we can make the change. If you are not participating, not voting, then obviously we can't bring changes, right? So that is only the matters here. So obviously you have seen in many movies also like Guru movies and all. So they will call all the shareholders, equity shareholders, they will come, they'll take decisions, right? So in equity shareholder, only you will be getting the voting rights. Preference shareholders will not be getting the. Okay. Yeah. Like normally what happens? Normally we also do voting. So one share, one vote like that. Okay. And normally during annual general meeting, we'll be voting. So these are the basic concepts. So obviously theory, you can spend a little bit more time. You can go through it. You can read in detail or how time permits, you can read through the concepts. Okay. Now, what we have to start here with. So next topic, what we have to start here is financial and operating leverage or leverage. Okay. So when I talk about leverage, okay, so you know about lever. Lever you have seen? Lever, like we make things smoother, do our work smoothly. Have you seen lever or something in any machine or something like that? So what is the work of lever in normal day-to-day life? Can you tell me what is the work of lever? What it does? So it will make our work smoother, easily, faster. Can I say all these things? Correct? Okay, fine. So here also when I talk about leverage, okay. So what kind of leverage I will get in finance? Okay. What kind of leverage I will get in finance? Okay. So mainly you know that if I talk about the objective of financial management, or if I talk about the objective of any organization or any company, so what do you think? What will be the main objective of any company or organization? Yeah, to maximize their profit, isn't it? They should maximize their profit. Fine. That is one objective. Second objective, can I say that all the stakeholders which we see in the organization, the another objective can be wealth maximization also. All are working. Why? Because they want that their wealth should increase, isn't it? All shareholders are there. They are investing in the company. Why they are investing? So that their wealth should increase, isn't it? Correct. If I say somebody wealthy means I say when somebody is having 4 or 5 cars, 4 or 5 plots, building, right? Right. So obviously we have to see for these two things. Either I talk about the wealth, that shareholders' wealth are increasing. Now, one simple question I'm asking. Suppose I say that we have two companies, type A and B. Suppose A companies pays higher dividends, pays good dividends, regular dividend. B company is not paying higher dividend. Okay, very less dividend it's paying. So in which company you will invest? A company, right? Why you invest in A company? So because it's paying a regular dividend and high dividend it is paying, right? So your wealth will increase. You will be wealthier, isn't it? Correct? So here also when I talk about lever or leverage, so here we have basically three types of leverage, but three types of leverage. I'll just write it first. Financial leverage, operating leverage, combined leverage. Okay. So same thing you keep in mind. I said we'll focus on two things, right? Either we see that the shareholders' wealth should increase. You are able to see my screen, white screen, right? Either you will focus on increasing the wealth of shareholders, or you will focus on increasing your profit, or also called as earnings before interest and tax. Okay. So this is what the meaning we have to understand the financial leverage. So in financial leverage, the leverage part or lever part is your debenture. Okay. We have to make use of debenture in our capital structure to increase earning per share. Okay. Obviously, those capital or those share whose earning is higher will be beneficial for you. You will raise funds through those capital only, which is giving you higher earning, isn't it? Correct? So in finance here, we say as earning per share. So if I'm talking about earnings of shareholders, I will say as EPS, earning per share. So how this debenture we are using as a leverage, so that earning per share is going to increase. Earning per share is going to increase. Okay. So this is only debenture is going to work as a leverage. So whether debenture is there in the capital structure or not, if higher the debenture, higher will be the earning per share. Okay. Like just now we have seen, we have equity capital, we have preference capital, we have debentures. So what should be the correct combination of your capital structure? You should choose. So on what basis you are going to decide about correct combination of capital structure? Based on this earning per share. So the capital structure or option which gives you higher earning per share will be beneficial for you to choose. Is it clear what I said? Any doubt? So debenture we are using as a leverage to increase our earning per share. So that is only called as financial leverage. That I will tell later how to calculate. First, let's understand the meaning of it. Just now I have explained, ma'am, debt or debenture means you are borrowing funds from the public or loan, you are taking it and in return you are paying the fixed interest. Like in Shark Tank also you would have heard, no, that you take 2 lakhs as debt from me, 5 lakhs as debt from me, pay 12.5% interest. So why people they don't agree? Because it will be burden, no? Paying every year interest without fail. If they are not making profit also, they have to pay interest. Same like loan, term loan. Okay. Meaning of financial leverage is clear. Next, we have operating leverage. So now this is the part of shareholders' wealth I have discussed, that how shareholders' wealth can increase. Now I'll talk about profit. So in operating leverage, I'll make use of the fixed cost. Now, one simple thing you tell me, if your cost is higher, your profit will be less or your profit will be more? Profit will be, yeah. So here in operating leverage, we are making use of fixed cost. We are using fixed cost as a leverage to see whether we are getting profit, higher profit or less profit. Or profit are also called as earnings before interest and tax. Or also somewhere I can say operating profit, all are same thing. So obviously I can say somewhere, suppose fixed cost is 200, fixed cost is 500, fixed cost is 1000. So in all three situations where fixed cost is lower, your profit will be more, isn't it? Correct? If your fixed cost will be higher, your profit will be lesser, isn't it? Correct? So fixed cost means the cost which remain fixed over the period of time, like your building rent or and all, whether you use the house or you don't use the house, you have to pay the rent, isn't it? So that is what fixed cost will be using as a leverage to calculate profit or EBIT, or it will be having impact on profit or EBIT. That is called as operating leverage. Is it clear? The meaning is clear? अभी मैं बोलूं कि जस्ट सिंपल एग्जांपल, सेल्स आपका है 10,000, सेल्स यू हैव 10,000. अभी जस्ट फॉर्मेट इज समथिंग एल्स, आई विल गिव फॉर्मेट. अभी फिक्स्ड कॉस्ट बोलूं 5,000 है और यहाँ पे बोलूं फिक्स्ड कॉस्ट 4,000 है, कहाँ पे प्रॉफिट ज्यादा होगा? सेल्स माइनस कॉस्ट ओनली इज प्रॉफिट, राइट? So
Yes.
sales minus total cost only is profit, right? Total cost includes fixed cost plus variable cost, right? So if fixed cost is less means your total cost will be lesser, no? If cost is less means obviously profit will be more. Fixed cost itself is more. For example, I say your company building rent only is higher. You will be able to make profit. Tell me. Or very less profit you will make, right? But if you are managing from a small place, small rented place, maybe you can increase your profit, isn't it? And then third is combined leverage. So we'll combine, that is, if financial leverage and operating leverage will multiply, that is called as combined leverage. Means I'm combining debenture as well as fixed cost to increase my earning per share as well as profit or operating profit. That is called as combined leverage. Okay. Now first I'll give you format. Then I will give you a formula that how we calculate financial leverage, operating leverage and combined leverage. Okay. Now I'll give you one format. That format you remember, that is going to help you in many places. Okay. This is like master format, which you can remember. Normally, anywhere we starts with sales. Sales minus variable cost. We see here variable cost. Variable cost means the cost which varies based on output. Variable cost means which varies. Okay. It's not fixed. Like your salary is fixed, isn't it? Right. But if I say I'm paying you salary based on hourly working basis, then it is variable cost or fixed cost? Variable. How many hours you will work? You will get paid. Or take example of your electricity bill. How much you use, accordingly you will get, isn't it? So that is called as variable cost. So from sales, if you minus variable cost, you will get contribution. Contribution means how much actually is contributed for the profit. Like how much actually is contributing in your sales volume, your profit part, that is called as contribution. From contribution, if you minus fixed cost, fixed cost just now I said, which remain fixed over the period of time. So if you minus fixed cost, you will get profit or called as earnings before interest and tax or operating profit. Okay, all three are same thing. In somewhere book, if or in question in exam they write profit, EBIT or operating profit, all three are same thing. Don't get confused. Till here it's clear? Any doubt? Now, of course, EBIT is there. So I am going to minus interest. Earnings before interest and tax, right? So right now I am having earning before paying interest and before paying tax. So obviously I should pay interest to debenture holders or loan people, and then tax also I should pay, isn't it? Correct? So always remember, interest we calculate on debenture or loan. So check in question whether debenture or loan is there or not. So if debenture or loan is there, you are going to calculate interest. Interest. Okay. So once you will minus interest, you will get EBT. EBIT, if you minus I, left out is earnings before tax because interest we have subtracted. So left out is earnings before tax. Then you have to minus tax. So you'll get earnings after tax. EAT means earnings after tax. If you minus, it will become after. Is it clear till here? Any doubt? And always remember, interest we calculate always on debenture or loan. So if in question debenture or loan is there, then only interest will come. Any doubt till here? Earnings after tax. We are talking about earning. In few book, you will see profit before tax also. Like they can say PBT or EBT, same thing. They can say profit after tax or earning after tax. So it depends on book. Some books like writing, like foreign authors or foreign books, you'll see they will write PBT, PAT. They will not write earning. They will write profit. So it depends on book, but it's same thing. Is it clear? Then earnings after tax you got. Okay. Now, whose payment left out? Interest we have paid to debenture holder. Now we should pay
Preference.
dividend, isn't it? We have paid interest. So now we should pay dividend, right? From the profit. First we'll pay
Yes.
to preference dividend, right? Preference shareholders, we are going to pay first. So check in question, if preference capital is there, you subtract preference dividend. So what is left out is called as earnings available to equity shareholders. Earnings available to equity shareholders. Okay. So this is left out is earnings available to equity shareholders. Okay. Now, after this, what is my main purpose? To find out what is the earning per share, right? Isn't it? So earning per share formula is earnings available to equity shareholders divided by number of equity shares.